I sold 23 companies for just under $123 million. But that's not how this story starts. It starts with me selling my own company first and realizing, much later, I had absolutely no idea what I was doing. A strategic buyer asked me how much I wanted for the business, and I pulled a number completely out of thin air. No valuation, no competition, and no leverage. And no real understanding about how exits really work. I didn't know it at the time, but in that moment, I had already lost the most important move in the entire deal. And that mistake made me confront something most founders never hear. Not from advisors, not from brokers, and not from other entrepreneurs. Most businesses don't fail to sell because they're not good enough. They fail because of a handful of decisions made before the buyer ever shows up. In this video, I'll show you what nobody else tells you about exits. Not from theory, not from hindsight, but from the deals I got wrong. The ones I almost lost, and the ones that change how I look at business forever. And to do that, I had to start from the very beginning, from before I was selling businesses for others when I was building one of my own. Hi, I'm Nate Lind. I sell companies like realtors sell homes, specifically companies where the owner runs them remotely, like SaaS, e-commerce, technology, and digital marketing companies or other professional service firms that are selling between $1 and $30 million a year in gross sales. I've been selling companies for over a decade now, and in the past few years, I've managed 75 transactions, closed $123 million worth of deals as an M&A advisor. If your business has a strong positive cash flow and can be run from anywhere, chances are I already know somebody who wants to buy it. In fact, if that is the case and you work with me, I'll guarantee you at least 40 buyers and an LOI in 4 months or less. I was running an e-commerce supplement subscription box company, growing fast, doing what other people would call well. But inside the business, I was struggling with something most founders don't talk about. It was hard for me to tell how much money I was making, how much cash flow, real profit. Revenue looked great on the surface. It was growing and becoming massive. One year, we sold over $36 million worth of supplements. I had 26 employees, a 16,000 square foot building, thousands of shipments a day going out the door. But supplements can be a brutal business. Inventory has to be bought months in advance, advertising can change overnight, and cash flow was a real nightmare. Between ad costs changing and inventory, we always seemed to be cash poor. When the sales were good, I felt good too. But when sales dipped even a little, I felt this knot in the pit of my throat. It was like emotional whiplash, and I felt like everything could unravel. So I built a tool to fix that problem. I built a SaaS reporting platform called OfferProfit. It sat behind the customer-facing front end of my e-commerce business and showed me something I desperately needed: the truth. OfferProfit helped me understand my profitability, but it didn't get me my life back. I was still working longer hours than ever, still chasing stability, still telling myself that when things smoothed out, I'd finally slow down. Instead, at the end of the workday, I'd come home and isolate myself in the bedroom. I'd turn on the TV or read, try to find something to shut down my anxious brain. Partly because I wanted to relax, and also because I didn't want to bring my stress into the home. I thought I was protecting my family from my emotional state. Looking back on it, I was just exhausted and stressed out. One Saturday, I was feeling pretty good, and I took my boys to the Sangre de Cristo Mountains in northern New Mexico to go for a hike. And my boys were doing what boys do: playing with sticks, poking at anthills, fighting imaginary monsters. It had been months since we'd done something like this together. And my youngest son, Aiden, looked up at me and said, "Dad, why can't we go hiking more often?" Without thinking, I said, "Son, Daddy has to work so I can pay for everything." It took a little while for those words to sink in and hit me, but I knew exactly what I was becoming. My dad was a colonel in the Army, and he worked 14 to 16-hour days at the Pentagon. He provided for us, but I barely saw him. And there I was, repeating his pattern as my own and barely spending any time with my kids. That's when selling OfferProfit stopped being a business idea. It became personal. It wasn't about maximizing value. It was about getting time back with my kids before I lost them completely. So when a strategic buyer approached me about the software, I didn't see it as a negotiation. I saw it as a way back to them. And that's exactly why I made my first mistake as a seller. But it would take me years, to understand it. The buyer who reached out to me wasn't random. They were a strategic company already operating in the same ecosystem. They were rolling up technology and performance marketing, and they'd already taken notice of my software, Offer Profit. Today, that company is known as Sticky.io, an enterprise-level shopping cart for e-commerce companies. Back then, Brian, the CEO, reached out to me with a simple company. Hey, how much would you want for Offer Profit? I'd never been approached by a buyer for something I'd built before. I didn't think to ask for time so I could go get a business valuation. And I didn't even bother reaching out to brokers to get their opinion, which in hindsight was a big mistake. I literally just thought about it for a minute and I named a number completely out of thin air without even thinking about it. At the time, it felt crazy high, but what I didn't understand at the time was I had made the most devastating mistake in the deal-making process. I gave out a price without doing any valuation research, and I was only working with one company, so I had no leverage to walk away. I had no other competition or other buyers in my pocket. I anchored the price without knowing the market, without knowing demand, and without knowing what buyers like them pay for companies like mine. What I didn't understand was how much I really didn't know. I thought that selling a business came down to one thing: price. It wasn't until later that I learned there are 27 different factors that goes into valuing and selling a business. 27! Things like market demand, buyer psychology, risk concentration, growth trajectory, transferability, financing availability, just to name a few. At the time, all I knew is I had something they wanted, and they could either buy me and incorporate my code into their system or build the code from scratch themselves. So when I named a number, I wasn't negotiating poorly, I was negotiating blind. And the buyer across the table from me, they weren't blind. Acquisitions was a part of their strong suit. They had done this dozens of times, but this was my first exit. So the negotiation didn't feel like two equal partners meeting in the middle. It felt more like a customer haggling a used car salesman. We went back and forth on price and on terms. And the terms, that's where my real risk showed up. The deal wasn't all cash on closing. Payments are spread out over time, all seller finance. By this time, I was already a little exhausted by the negotiation process, and I gave in. I told myself the same thing a lot of founders end up telling themselves. I just want this done. I wanted the pressure gone. I wanted the development team off my hands. I wanted the weight off my chest, and I just wanted my time back. And that feeling of relief replaced leverage without me even realizing it. I remember walking into my CFO's office, Mary, and asking, "Did the wire come in?" She smiled and said, "Yes, it hit today." In that moment, I felt validated. Somebody saw what I built, valued it, and paid real money for it. I felt like I had won, which, to be fair, I did. I'll tell you something I've never shared publicly before. I sold a negative cash flow SaaS, a startup only 16 months old, with only 5 or 6 customers, and I got mid 6 figures for it. It had only cost me about $40,000 to build, but it wasn't until much later that I realized what that win actually cost me. Every month for the next 2 years, I checked my bank account to see if the seller finance payment arrived, and have the anxiety of wondering, were they going to keep paying or stop? Fortunately for me, I got every dime promised to me. Could I have gotten a better deal? Maybe. I tried 2 other competitors who didn't bite. Could I have structured it differently? Without a doubt. But here's the honest truth. That exit gave me something way more valuable than a crazy high multiple. It was a spark that gave me an opportunity to take my life back. I changed my life. I brought my boys home and into homeschooling, and now I have more time with them than I've ever had before. And that experience taught me something that I didn't know then, but I understand completely now. It's much harder to build a truly passive business than it is to sell the business and use that liquidity event to put your money into cash flow producing investments. And that realization stayed with me. You see, Robert Kiyosaki and Rich Dad Poor Dad changed my life, but he missed something in that book. These liquidity events are really what give you the opportunity to invest in passive income. And I'm not talking real estate, apartment complexes, and things that you still have to be a property manager or hire a property manager and then manage the property manager. I'm talking true passive investment and true passive wealth. Because once you've lived through an exit, once you've felt the relief, experienced the regret, and start to see the clarity that comes afterwards, then you truly understand the power of an exit. And a few years later, that's exactly what pulled me to the other side of the table. After I sold Offer Profit, something unexpected happened. So much of the pressure was gone. I had time with my kids again, and it felt like I could breathe easy for the first time in a long time. But mentally, I kept replaying the deal in my head over and over. Not because I was upset, but because deep down, I didn't really understand what I had just been through. I started asking myself questions I hadn't asked before. Why did the buyer negotiate the price before even bringing up the terms? How did the buyer know to structure the term in his favor while I didn't? Why did it feel like they were calm and methodical, while I was anxious and nervous and just relieved it was over? And why did it feel like I stumbled into an exit instead of intentionally creating one? A short while later, I started talking to experienced business brokers for the first time. Not casually, but deeply about the tech and internet M&A world and how it worked. I wanted to understand their perspective, and these conversations changed everything for me. These brokers told me there were thousands of active buyers looking for businesses like mine. Not hypothetical, real, actual buyers. You have all sorts of buyers: private equity, strategic buyers, family offices, and individual owner-operator investor types. I remember thinking, how did I not know this? Where was this market of buyers? That's when I realized something important. My exit didn't go the way it did because I was unlucky. It went the way it did because I didn't understand the market I was operating in. Exits weren't about finding a buyer. They were about accessing a market. And once you understand the market, leverage, structure, outcomes all start to make sense. I didn't wake up one day and decide I want to become a business broker. What I felt inside was like a growing responsibility. I lived the part that most founders never see until it's over. I knew what it was like to leave value on the table, not because I was careless, but because I didn't know any better. And once you know that, it's really hard to watch other founders stumble through the same thing. That's how I ended up in the middle of it all, working at a brokerage. Suddenly, I wasn't seeing one deal at a time. I was seeing hundreds. What sold, what stalled, and what quietly fell apart. The same patterns started to show up over and over again. It was like I was Neo in the Matrix, and I could start to see the code behind the scenes. Some businesses had great growth and great sales, and still didn't sell. Others weren't perfect. They were owner-operator businesses and still generated a ton of buyer interest. The difference wasn't luck. It was preparation, it was structure, and it was timing. And once I saw that clearly, there was no going back. Because understanding exits in theory is one thing, but watching deals fall apart in real time, sometimes days before closing, is something else entirely. Most founders think that deals fall apart because the buyers get cold feet. But after watching hundreds of deals across the brokerage for over 5 years, with my hands personally on 75, over 20 of them closing, I can tell you that's almost never what kills the deal. Deals usually break after the LOI, once the due diligence starts. When the business hasn't changed at all, it's just that the risk becomes visible. And internet-focused businesses carry a unique type of risk. Customer acquisition costs are usually at the mercy of big platforms like Meta and Google. Consumer product companies have inventory, which is usually capital intensive. Margins for any business can get squeezed quietly. And cash flow, which looked stronger on paper up front, can look incredibly sensitive when it goes through intense scrutiny. Buyers know this. Lenders obsess over it. I had a client selling an e-commerce business in the women's health and beauty space. They had a really strong brand, clean financials, and a healthy EBITDA. We had a signed letter of intent, went through months of due diligence, financing was approved, and the lawyers were all aligned. Closing was scheduled for a Friday, but at the last minute, the sellers tried to retrade the deal and push for more money. The buyer was angry at the retrade, but they relented. The extra money would come in the form of an earnout, so it wouldn't affect the financing and change the closing. But that decision did delay the closing by one day. It went from Friday to Monday. And that Monday morning, President Trump announced new tariffs on China. The buyer still wanted the business, and nothing about the company had changed. But the lender got nervous about inventory exposure because some of the products were coming from China, but only a small amount, like 7%, even though the headlines in the news was enough to spook the lender and they pulled the financing. And just like that, a $17 million deal that was ready to close fell apart. That deal didn't fail because of valuation misalignment. It failed because momentum protects deals. The longer a deal stays open, the more exposed it is to external risks. External risks like tariffs, increase in ad costs, and lender sentiment. For technology and internet-focused businesses, time is risk. I had another deal, an $11.5 million e-commerce transaction. Its profits dipped in the final months before closing. Nothing dramatic, just some seasonal bumps in their advertising. Normal operator stuff. But the buyer came back and demanded a retrade, and the sellers panicked. They were contemplating giving up millions just to keep the deal alive. But we had multiple offers. We had real buyer demand. The buyer had already sunk tens of thousands of dollars into due diligence and legal, and he had already lost another deal earlier last year. So I told him my clients were prepared to walk and go with the next best offer, and I meant it. The buyer backed down. He folded like a house of cards. We did concede some value, but we protected the majority of it, and that deal closed. After seeing this enough times, the pattern becomes impossible to ignore. Retrades from buyers don't happen because they are finicky. They happen because risk shows up and sellers don't know how to respond. Whoever understands the deal structure the best and is willing to walk controls the outcome. And most deals don't die because of buyers and lenders. They die because of the sellers. I have walked away from clients who've hid cash sales off the books, manipulated inventory purchases for tax purposes, had excessive personal expenses hidden as a business expense, doing simple things out of ignorance, which the buyer confuses as intentional and sometimes malicious. Buyers see this immediately, and lenders will sniff it out. And no amount of storytelling can fix financial broken trust or repair the loss in credibility. I've been brokering businesses for a decade. I've seen thousands of transactions, and I've seen it all. And here's the harsh truth. Even though there is a huge demand in the market, less than 1 in 12 businesses actually sell. And internet and tech businesses, often the results are far worse. The deals that close aren't always the biggest. They're the ones where risk is understood, expectations are aligned, and momentum is kept up all the way to the wire. Watching deals fall apart this close to the finish line fundamentally changed how I approached exits. Because once you understand where internet and tech deals actually break, you stop hoping things will work out, and you start removing uncertainty before it ever shows up. And that's when my entire process changed. Most exits don't fail because the business isn't good. They fail because too much is left to chance. It could be anything: buyer financing, lender confidence, the seller's expectations, or momentum. But when those things aren't controlled early, they break quietly and they break later. The traditional process looks simple on paper. List the business, buyers show interest, you get an LOI, and then the real work begins. While buyers are figuring out financing, the sellers are hoping that due diligence goes smoothly, and brokers hope nothing spooks the deal. In that model, nobody owns any certainty. At some point, I stopped asking, who's the buyer? And I started asking a much harder question. What would have to be true for this business to actually close? That question fundamentally changes how you approach an exit. Today, before I take a business to market, I want to understand financing for the buyer first. Not hypothetically, but specifically. Can this business support debt? How much leverage will the lender allow? What does cash at closing realistically look like? How much of it's coming from a lender and how much of it's coming from the buyer? What risks will be a deal breaker to the lender? Customer concentration? Cash flow fluctuations? Declining margins? Once you answer that, most of the uncertainty disappears. When sellers know early on how much cash they're going to get at closing, what portion of the deal may be seller financing, whether they'll have to roll some equity and become a minor partner for a period of time, and for how long, expectations stop drifting, panic goes down, and the potential for a retrade disappears. And decisions become calmer because nobody's guessing anymore. Across my career, I've taken 75 deals to market. 23 of those closed, which puts my career close rate at 30%. In a market where only 1 in 12 close, that's only 8%. But in the last 2 years, my close rate's gone to over 75%. That's not because these businesses are perfect. It's because I've created a system where fewer things are left unresolved up front. On average, my listings attract 97 buyers. More than half of my closed deals had multiple offers. That competition doesn't come from hype, it comes from preparation. When a buyer sees a deal that's been vetted, can be financed, and cleanly presents the upsides and the warts, because every deal has some warts, they bid quicker, more confidently, and more aggressively. On average, it takes about 5 months to get an LOI, and another 3 to 4 months from LOI to close. That's a long time for an internet or tech business to be exposed to fluctuating ad costs, to inventory issues, and to news or headline events. The tighter the process, the less surface area is exposed to something going wrong. Looking back, this was the part I was missing in my own exit. I didn't lose leverage because I was careless. I lost it because I didn't understand where leverage truly comes from. Leverage doesn't come from a false sense of confidence. It comes from preparation and clarity and optionality. Today, I don't see exits as transactions. I see them as systems. Systems where every unanswered question becomes a risk. And my job is to eliminate as much of that risk before the first serious buyer comes along. And when you do that long enough, when you watch founders step out of businesses that once consumed them, you realize exits are never really about the money. They're about what comes next. And that's the part most people never plan for. After enough exits, you start noticing something most people don't talk about. Okay, so yes, the money does matter. Of course it does. But it's rarely the part founders focus on most. I've watched founders close deals and do things they've never done before in their life, or stuff they haven't done in years. One client retired to the south of France after running her business for over a decade. Another finally stepped away from being a daily operator and started mentoring young entrepreneurs. Others didn't retire at all. They invested the money, or they put themselves in positions that required far less of their time, effort, and energy. Different outcomes, same relief. Relief is the most commonly used word that my founders share after they've sold their business. There's a moment after every exit that looks almost the same. The documents are signed, the business is sold, the wires hit. Everyone congratulates each other, and then the founder goes quiet, not because they're unhappy, but because for the first time in years, the noise stops. The hard truth is, most founders don't plan their exit. They delay it. They tell themselves, I'll think about it next year, once the revenue's a little higher, after this next growth phase. And then the years go by, and their business becomes their identity. What I've learned, both personally and professionally, is that exits get harder the longer you delay them. Not financially, but emotionally. Because the longer a business defines your day-to-day life, the harder it is to imagine what comes after it. When I sold my first company, I wasn't thinking about any of this. I didn't understand any of this. And you might not either. I just wanted freedom. I wanted my life back. I wanted my time back. I became an entrepreneur because of Rich Dad Poor Dad. I wanted passive income, which to me was freedom. And in an interesting way, that's what most founders want. When they finally start thinking about selling, what the money really represents is freedom, more control of their lives, more time with their loved ones, and more options for the future. That's the part nobody tells you about exits. They don't end something. They create space for whatever comes next. And the earlier you understand that, the more control you have over how and when that happens. If you're a founder even thinking about an exit next month, next year, someday, the best time to start understanding what freedom you really want is right now. Because exits don't reward urgency, they reward preparation. That's why I built Maximum Exit, a system to help founders see what their business could actually be worth and how to get it, to show how buyers actually value their business and what we need to do to actually prepare for an exit. If you're even thinking about an exit someday, there's a short intake form below. It takes less than 2 minutes, but it could change how you look at your business forever. Because the best exits don't happen by accident, they happen by design. Thanks for listening to my story.